the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Tuesday the 9th at 3 p.m. in London, 10 a.m. in New York. We're 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alix, equities a little softer. The S&P down right now. If we rally into the close, we get 9 days higher. Last time that happened, 1964.
Really? I love that. What was the top song in 1964? Go look that up. That should be a good theme that we should play over the next 3 hours.
Even before my time.
Even before, just. Okay, so point to the equity market, very interesting in terms of that 9-day rally. The other kind of action here is what's happening within the bond market. Look at the 10-year yield. You have yields down now by about 5 basis points. A lot of buying coming in, particularly in the long end of the curve. We get $30 billion worth of 10-year notes coming in an auction at 1 p.m., so watch that takedown. Now, S&P now, though, down 0.4%, so we might not get that 1964 record. And you have the utilities that are leading the way, like utilities and real estate and consumer staples. So all the safety kind of trades doing the best within the S&P. GE, obviously, the outperformer. We'll get to that in just a second. So you have it feels like a risk off, but then you got Bitcoin, which is up by almost 2%. So maybe we can't look at it as a risk on, risk off kind of scenario throughout the day. And crude up by 0.6%. At 12 o'clock, that's going to be my game time. We get the EIA short-term outlook report. Everyone's kind of putting a lot of money on that in terms of will we get an SPR release, more oil coming out of the U.S., and that's going to definitely move the bond market, Guy.
Yep, absolutely looking forward to that. What's moving the bond market around at the moment seems to be Powell Brainard. When are we going to get a decision on that? So let's talk about the top stories we're watching this morning. Bloomberg's Anne-Marie Jourdain in Washington. Is it going to be Powell? Is it going to be Brainard? When are we going to find out? Please let it be soon. Mike McKee breaking down the US PPI data and critically looking ahead to the CPI number tomorrow. And General Electric splitting into 3 units. Karen Hubelhart joining us with the latest on that. So let's first of all deal with the Powell-Brainard debate. When are we finally going to figure out which way the president is going to jump? Anne-Marie Jourdain joining us from D.C. with the latest.
Well, we just don't know the exact time frame. When we asked the president this in Glasgow, he had said we'll know sometime soon, but now it does seem like it's coming a little bit closer to that decision with the fact that Bloomberg News, our colleagues are reporting that when Governor Brainard was at the White House last week to meet with the president, it was to interview for the top job. Many have speculated potentially he would keep Powell at the top job, but put Brainard as part of the supervisory chair position that Quarles is leaving. But now we know that Powell potentially has this serious rival, but a lot of questions still remain. Mike McKee actually has a great thread on Twitter. He's going to be coming up next, but potentially will she have a little bit harder of a confirmation hearing? Is this something that potentially Biden wants to extend some political capital on? It would definitely be a nod to the progressives who think she's much tougher on banking regulation, even though Brainard and Powell really are lockstep when it comes to monetary policy. The changes would be in terms of banking regulation, as Mike points out, ESG policies, especially climate change. I think one thing we should note, though, over the summer, our reporting was that Treasury Secretary Janet Yellen told the economic advisors around President Biden that she supports the reappointment of Jay Powell. Is President Biden actually going to ignore the advice of Treasury Secretary Yellen, a former Fed chair herself?
All right, Anne-Marie, thanks a lot. Bloomberg's Anne-Marie Jourdain joining us there. It's going to be really interesting, and it's kind of like, what's taken so long, guys? All right, let's get to the deeper debate then. If you stick to the economic news, you got prices paid in the U.S. producers accelerated in October. Of course, that fuels concerns about persistence of inflationary pressures, and then you get the rally in the bond market. So something odd is happening there. Michael McKee, Bloomberg National Economics and Policy Correspondent, is with us, as well as to break down Powell versus Brainard.
Yeah, Alex, it doesn't matter which person is the Fed chair. They're still going to face the same problem in 2022, and that is inflation. You see that PPI for final demand, which is the headline number, and PPI core, both are up. It was a no-change month for both of them, but that means they are still both at records. Now, this doesn't get a lot of attention on Wall Street. What really matters to people on Wall Street is the PCE, which is the Fed's favorite indicator, and the CPI, which comes out tomorrow. So how will this influence the CPI? Well, the CPI is expected, the forecast, to go to 5.9%, which would be the highest in decades, and 4.3% of the core. The headline is higher because that includes, of course, food and fuel. And according to the Bureau of Labor Statistics, the PPI was heavily influenced by the price of gasoline this past month. And so where does this leave us going forward? Are you going to feel a political impact from this? Well, maybe not. You take a look at this. The white line is the employment cost index. This is how much the raise you've gotten went up over the past 3 months. And these are the inflation indicators, the PPI, the CPI, the PCE, and then the CPI is the purple one. And you can see that CPI looks really bad for you, but the other indicators are not quite as bad. And if inflation can keep up paychecks can keep up with inflation, that might work for the political side of this with the president. He's got to hope that we keep getting more money to workers and less money going out the door for oil and fuel. By the way, Guy and Alex, I can tell you, 64, pretty obviously the Beatles.
Yeah.
I Want to Hold Your Hand was number 1, and She Loves You is number 2, but number 3 you will never guess.
What?
Hello, Dolly by Louis Armstrong.
Oh, no, actually,
You would never, I knew you would never get that one.
No, but now that you say it, it kind of makes sense.
She's now claiming that she would have got it, basically, is what she's saying here. Yeah, much to the annoyance of my father, I was never a Beatles fan.
You can't say that. You're British. You literally can't say that. It's like blasphemy.
I know. As I say, much to the annoyance of my father, who finds it bewildering. It's been a family debate for quite a while. Mike McKee, thank you very much indeed. Looking forward to the continuing conversation around what is happening, A, with the data, and B, what is happening with the Fed and who is ultimately going to end up leading it. So let's talk about the GE story. I spent a large chunk of my career working for GE, the once mighty American conglomerate we now know is going to break up. General Electric will split into 3 companies. The first one is going to focus on healthcare, then we're going to get power, then we're going to get aviation. It's the most sweeping and significant change for GE, well, forever, like it says on the screen in front of me, since Larry Culp became CEO in 2018. I would argue 2008, the pivotal turning point. I remember being there at that point. And once the financial crisis hit and GE Finance started to experience problems, maybe this was always on the cards. Karen Ubelhart, senior analyst for machinery at Bloomberg Intelligence, joins us now. And that's my question, Karen. This feels like it's been kind of on the cards for a long time. My question, therefore, is why did it take so long?
A couple of things. The debt structure had to get in much better shape. They were very over-levered. They needed the cash flow from healthcare and aviation. They weren't in a financial position to do it. They are now with the sale of the AerCap business. They now will have debt down $75 billion. So that's the timing part of it. Frankly, I think the timing of the announcement was a surprise, premature, earlier than I certainly expected. The timing of the splits, the planned timing, though, sounds really right. Healthcare first, the power business later. 2023, 24, aviation will be in very good shape. So the timing sounds right.
If you take a look at the different valuations each of these companies alone will command, which has the most upside from right now?
Aviation. Aviation is under earning. I mean, the rebound is happening faster than expected because of the commercial aftermarket. But the earnings power of that business is so much higher than it was in 2019 once we get the full recovery. So that's the best business. Healthcare is also a very good business. It's been a good business. It really hasn't run into problems. They'll now be able to be more focused, do more M&A, get more growthier businesses. So that makes sense. And power, the basket of power, which is renewables and power, and a little bit of digital, that's still going to be not a great business, but it'll be a fixed business. I put fixed with quotes, mid-single digit, high single digit margins, low single digit growth. Not a great business, but it will be earning solid money. So that's the timing is right.
Karen, thanks a lot. You've been covering this for a long time. You've been calling for this for 3 years, right? So finally it's coming there. Karen Ubelhart of Bloomberg Intelligence, thank you so much. And a programming note, Larry Culp, General Electric Chairman and CEO, will be joining Balance of Power today at 12:30 p.m. in New York, 5:30 p.m. in London. Definitely don't miss that conversation. All right, coming up, we got stocks trading a little heavy here. Looks like we don't want to hold our hands. S&P 500 easing off on its longest run since 2017. Is this the end of the winning streak? Emily Rowland, JH Investment Management Co-Chief Investment Strategist, joins us next. This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. So one of the big expectations of yields rising this year is that value stocks would actually surge and wind up beating growth. Guess what? That hasn't actually worked out. Joining us now is Bloomberg's Abigail Doolittle. That was sort of the consensus for like a second, and it just hasn't panned out yet again. Value can't get the bid.
It really has not panned out at all. And this is a stark reminder of it. Overall, we have growth up about 28% on the year, value up about 20%. Not so shabby for both. But to your point, Alex, Tesla, NVIDIA up huge, huge way. And on the other hand, some of the top value stocks, Disney and AT&T, actually lower on the year. So it is a busting of that idea that rising yields would really help out value. It just hasn't helped out that way, worked out that way. But also, when we take a look at valuation, we're going to see something interesting happening, which is the spread between value and growth has really widened. So back at the end of 2018, the value PE was almost 13 times. For growth, it was almost 19 times, so a spread of 6. Right now, we're looking at almost a spread of 15. Value's trading at about 17 times, growth trading at 31 times. This may suggest that there could be some catch-up for value ahead, something that everybody's been waiting for a long time, but it's not working out that way yet. And tying it back to yields, if we go into the Bloomberg terminal and take a look at what's happening, because again, rising yields supposed to help. Rising yields, the 10-year yield up about 50 basis points on the year in blue. It's been a very choppy ride, but below we have value versus growth, and value really just not performing at all, growth taking the cake.
It's amazing, isn't it, considering where we were and where we've come from and the message that was delivered earlier on this year. Abigail, thank you very much indeed. Bit of breaking news. Hertz indicated to open 29.50, the offering priced 29, so we're kind of picking up. So we're kind of 29.50. We're basically around the offer price. But if you think about where we've come from, that's an amazing result.
Yeah.
Absolutely sensational result. This was a company that was on its knees, Alex. And to come back to the market in such form and to be able to basically deliver this kind of a share price turnaround, sensational.
Yeah, I'm sure the whole EV Tesla thing didn't hurt matters before the IPO. But from bankruptcy to this, it's definitely a big bounce. Also just shows the kind of money that was in here, too. And the fact that this was at some point sort of a meme stock. Remember when it filed for bankruptcy and then it could still wind up issuing shares? I mean, that's crazy.
All kind of normal practices, normally what you would expect to happen, thrown out of the window.
Yeah.
Anyway, we'll come back. We'll see exactly what it opens and what it looks like when we get to that point. We'll bring you the news a little bit later on when that happens. OK, let's talk to Emily Rowland, JH Investments Management Co-Chief Investment Officer. Emily is worried that there aren't enough bears about, and that this market has lost its bearings, if you get the joke. Emily, thank you very much indeed for your time today. We've had record high after record high. We're a little softer today, but if we have 9 days higher, we haven't seen that since 1964. Apparently, that was when the Beatles were in charge of the charts. Emily, how big a problem is this? And what do you think about these markets right now? Are you comfortable with where we are, or are you worried actually we're setting ourselves up for disappointment?
Well, thanks for having me. I'm still a little bit worried about the fact that you're not a Beatles fan, Guy, but I think we'll have to come back to that one later on. So, you know, I think what's interesting about this market right now is that it does have a lot going for it. The economic data has been surprising on the upside. You know, last week we saw U.S. services PMIs at a record high. We saw the U.S. economy add over 500,000 jobs with significant upward revisions to previous months. And the fundamentals look great as well. Q3 earnings season really couldn't have been better. 39% year-over-year growth, reflecting this really strong demand backdrop. And then you've got some significant risks that are fading. You know, COVID certainly is one. We've got these new treatments announced. We have kids now being able to get vaccinated. You know, higher taxes are fading as a risk at the margin as this infrastructure bill gets watered down. And then finally, you've got a ton of cash on the sidelines that's looking to get deployed. The challenge is that we're starting to see these pockets of speculation building again. You've got small cap stocks ripping. Mm-hmm. You've got, you know, meme stocks coming back into the narrative. You know, and you've got bears really starting to capitulate. I've seen it significantly on Bloomberg over the last few days. Some of those bears that we've heard from over the past few months saying that they're waiting to buy the dip. They're not waiting anymore. Mm-hmm. If you looked at the Bank of America fund manager survey a month ago, investors were bearish both stocks and bonds. And clearly, you know, that was wrong. So when we think about our view heading into next year, it's really about, you know, don't get too comfortable in the fast lane. Don't overreach for risk in this market. And in fact, we think it's going to be important to be more thoughtful about where and how you're invested into next year.
So, Emily, does that mean that you want to sell rips and then put some cash on the sidelines and then buy the dips?
We want to sell areas where there is, you know, speculation. We want to sell the highest, most cyclical areas of the market. We want to fade things like commodities as we head into next year. And we want to embrace quality. We want to look for stocks or sectors that have great balance sheets, good return on equity, great earnings prospects as we head into next year. You know, in the previous segment, there was a conversation from Abby around valuations. And, you know, we tend to look more, you know, of course, the PE ratio has a numerator and a denominator. The numerator is prices. The denominator is earnings. And we think the denominator is more important. And when we look out into next year, the quality growth sectors that we really like, areas like technology and communication services, are showing the best earnings growth prospects, along with some higher quality cyclicals like industrials. When we look on the value side, those earnings growth prospects are actually starting to fade. The financial sector is showing negative earnings growth for 2020. So we want to be very mindful of that. We just want to notch up on quality. We still want to embrace equities. This is not an overly bearish message, but as the economic growth backdrop slows, you want to be more careful about where you're invested.
So you still want to embrace equities. Let me ask you, therefore, the question that I asked Kate Moore yesterday. Her answer was absolutely. Do you want to be fully invested at this point?
You do. You know, we continue to embrace value and growth. So you want those higher quality value stocks. You want to own growth stocks. You want to also have a balanced portfolio. You hear a lot, and I know it sounds boring, but you hear a lot of folks talking about sort of, you know, the death of fixed income. You don't want to own bonds in this environment. We actually think that you've got to own a combination of higher quality bonds to offer that buffer if we see volatility next year, which we do expect, and you want to pair that with corporate bonds, particularly in the BBB and the BB space, in order to capture that additional yield. So we still think that equities need to do a little bit more of the heavy lifting here. We want to own bonds in that intermediate part of the curve. There's great roll down potential there. Where we don't want to be, Guy, is in cash. Cash is simply going to be a very, very inefficient asset class. The Fed, we think, is going nowhere. We think rates stay lower for longer. Mm-hmm. And right now, of course, you're losing money if you own money market funds or cash, where, frankly, a lot of the flows are actually going.
Hey, Emily, before we let you go, we started talking in the show about Lyle Brainerd versus Fed Chair Jay Powell. The excuse for the rally in the bond market yesterday was that we may get a Lyle Brainerd Fed Chair. How do you factor that in? How much do you care about the two, between the two of them, who leads, and like how does that affect any investment decisions you may make?
Yeah, well, I wouldn't overemphasize that as a key catalyst for the market. And first, just to answer the question around bond positioning, you know, we look at the rally that we've seen in bonds as just a shift in positioning, as investors were overwhelmingly positioned prior to the Fed meeting for rates to back up. And those positions needed to be unwound. And that's one reason that we think that we're seeing this rally in bonds. As far as the decision between Brainerd and Powell, probably won't put much of a dent in markets. As we've just talked about, not much can right now. So we don't think that that event will cause significant volatility. The challenge for if we do see significant turnover on the Fed, which regardless of who the chairman is, we are going to see significant turnover. This cycle is moving quickly. This is a new Federal Reserve that could get put to the test very, very fast. And we've seen with Powell that sometimes it takes a little bit of runway to get that communication just right, to get that messaging just right. And that could be a challenge as we have a more kind of junior group of Federal Reserve officials into next year at a time that the economy is slowing and if inflationary pressures potentially need to be snuffed out more quickly.
All right, Emily, thanks a lot. We really appreciate it. Thank you very, very much. Emily Rowland of JH Investment Management, thank you very much. And just to update you on what's happening with Hertz, we're looking at indicating to open about $26. The stock offering, remember, was priced at $29. Tom Brady apparently also just tweeting to the moon in a Hertz reference. There you go. We spoke to Tom Brady earlier today about Hertz and its IPO. Today, we'll keep you updated on the price. Still ahead, ROBLOX investors reaping the rewards of teens staying glued to their phones even as the COVID lockdown eases. This is Bloomberg.
Okay, let's talk about what is happening in the market right now. Mobile gaming company ROBLOX managing to double its Q3 revenue once more, even as kids go back to school. Dave Wilson, looking at the numbers and the pop that we're seeing in the share this morning.
Yes, quite the pop, Guy, no question. Yeah, and bear in mind, ROBLOX is one of these companies that when you talk about the metaverse, it has to be part of the conversation. It's not just Facebook and its Meta Platforms parent company. You know, it's ROBLOX. So video games, people can create their own games. They can share them with others. And that model seems to be working out for them at a time when we're seeing other companies kind of struggle to hang on to their business, you know, in light of the coronavirus pandemic easing. ROBLOX doing just fine, as you mentioned, more than doubling its revenue in the third quarter as it did in the second quarter and in the first quarter. And we should bear in mind, this company's only been public since March. So, you know, quite the start for ROBLOX. I mean, it comes at a cost, no question, when you look at sort of how the results break down. You know, things like developer fees and personnel and all the rest. And it kind of leaves them with an operating loss for the latest quarter. Though if you make the adjustments, it turns out that they had earnings that beat analyst average estimate in the Bloomberg story. Similar survey, similar story with revenue.
So, Dave, ROBLOX gets a boost from analysts as those results do look better. But hasn't the games industry been really closely tied to the pandemic? So I just wonder what happens as the reopening trade, which we are still seeing, has more juice.
I mean, there's no question. If you look at an index of video game makers, it peaked back in February, down as much as 25% since then. ROBLOX, though, really kind of defined the broader trend. I mean, you're talking about a stock that set a record today, and their average daily active users actually rose in the third quarter, which is saying something.
Yeah, no, it is indeed. That guys' kids are still playing, basically. All right, Dave, thanks a lot. Dave Wilson, good to chat with you on that. All right, coming up, COP26 is still in the thick of it. Christiana Figueres is Global Optimism founding partner and former executive secretary of the UN Framework Convention on Climate Change. We'll get her take. This is Bloomberg.
Maybe the next generation is going to give us absolutely zero emissions.
It's important for us to recognize that, as was true 5 years ago, we have not done enough.
World leaders haven't, up to this point, delivered on their promises. They haven't acted fast enough.
What excuse should we give for the failure?
It is not a secret that COP26 is a failure. We don't need any more distant, non-binding pledges. We don't need any more empty promises. We don't need any more commitments that are full of loopholes and incomplete statistics and that ignore the historical emissions and climate justice.
For any government, it's not as simple as flicking a switch. There are careful transitions that need to be done, and that is an energy transition.
Those were some of the heaviest hitters in global politics and activism in the environment, saying that there is a lot more work to be done. That's all coming off the heels of COP26. And currently, House Speaker Nancy Pelosi is also in Scotland, and the U.S. congressional delegation to COP26 is holding their news conference in Glasgow. I'll bring you any headlines that cross as we go. Let's get a report card on where we are. Christiana Figueres is Global Optimism founding partner. She's also former executive secretary, UN Framework Convention on Climate Change. She was one of the architects of COP21. That's when we had the world come to an agreement. COP26 is where we kind of get more details. Christiana, I know you've been looking at all the headlines that have come out of COP26, a lot of big promises. Can you grade for us how you think everything's going?
Yeah, hi, Alex. Thanks for inviting me back on. I would say there's definitely been progress, and much more progress needs to be done this second week. I would actually choose 3 big ticket items. Number one, 1.5 degrees is the new 2 degrees. What that actually means is that we thought several years ago that a maximum temperature rise of 2 degrees would be more or less okay. It's not. Scientists are screaming from the rooftops that we have to actually be able to limit warming to 1.5. So that is actually very important. This is the first COP at which there is unison agreement. Has to be formalized at the end of the week, but it is definitely clear that 1.5 is now the new 2 degrees. The second point that is a big ticket item is the role of nature. All of a sudden, it has exploded at this COP, with 100 countries pledging to reverse deforestation by 2030 and $20 billion of public and private funds being allocated to that challenge. And perhaps the most exciting thing, Alex, is how the finance system is moving. At this COP, we had more than 450 financial organizations in the financial sector, including banks, fund managers, asset owners, insurance companies in more than 45 countries, pledging to move $130 trillion of funds to a decarbonized portfolios. So 3, I think, very, very important big ticket items with a lot still to be done.
Christina, it's Guy in London. 1.5 is the new 2% for those that were present at the meeting. The problem is, though, China wasn't present at the meeting. Plenty of other important countries weren't present at the meeting. How effective can this all really be if those countries aren't on board?
No, they are on board. Just because they didn't come doesn't mean that they're not on board. Actually, it is China and India are very much moving toward a 1.5 degree because they know that it actually can be quite dangerous for them if we don't do that. So those are not the countries that have been a problem. The countries that are still having a very hard time accepting the fact that we have to decarbonize the global economy are actually Australia, Saudi Arabia, and Brazil. And for obvious reasons, but I have a feeling that even they will have to give in to what is by now a majority position on the responsibility that we all have to stand up to the exigencies of science.
Christiana, what role do you think that coal, I'll even say coal, nuclear and natural gas need to have? It feels like you can't win any way you slice it. And that's been quite a disagreement, it feels, at COP26 in light of the energy crisis. How would you think about it?
Well, on coal, it's pretty clear. No more new coal. That is absolutely clear. We cannot even afford to take the coal plants that have been mothballed because they are such stranded assets. We can't even afford to bring them back into operation. And Alex, the very dangerous thing is that with these absolutely crazy gas prices that we have right now and electricity prices going through the roof because of gas prices, there is some temptation in some countries to take those coal plants out of mothball and have them, fire up again. This could be a make it or break it winter for many countries, and in fact, even for progress on climate change, because of that temptation to put highly inefficient, costly, and highly polluting plants back onto the grids. And it only underscores how we absolutely have to invest deeper and much, much quicker into the cleaner energies that are, of course, all of the traditional energies by now, solar, wind, but a very exciting new energy that is beginning to emerge, so watch that space, is actually using renewable energies to produce green hydrogen. That actually means that you can then substitute power, coal power, and gas in heavy industry. And that is actually going to be the most important contribution to the decarbonization of the economy.
Christina, when are we going to get a carbon tax, a global carbon tax? And when are we going to get penalties for not living up to promises?
I don't think you're going to get penalties. We went through that during the regime called the Kyoto Protocol, which if anyone is old enough to remember, I certainly do. But during the Kyoto Protocol, we had penalties. And the only thing that that led to was that those countries that were not complying just pulled out of the agreement 24 hours before the penalty would have been imposed. So that was a big lesson learned. That is not going to happen. Much more important in terms of punitive measures is the peer pressure that countries are getting from young people, for sure, thousands and thousands and thousands of them on the streets, but also from scientists, from anyone who is aware of what is going on. So I think punitive measures have been substituted by peer pressure, and that has to remain.
Christiana, one thing that may bridge both is a carbon tax, basically setting a carbon price and having a carbon trading market that's liquid and that can be very much participated in. It still feels like we're far away from that. Every CEO that I talk to wants that. What do you think is the right price and the right structure that will really incentivize change?
Well, what I know is not the right price is the ridiculous price that we have now, which is $2, $3, $4, $5 a ton. That's ridiculous. It has to actually go up very, very quickly to perhaps even $100 a ton in order to really make a dent. When are we going to get that global price? Well, it has been lagging since the Paris Agreement, I'm afraid to say, in 2015, because there is not agreement from everyone either to make it a global market, liquid, as you say, or in fact, to do so with transparency and without double counting, which is absolutely critical because a global market that has double counting is not going to help us at all. So those are the 2 points that are still being discussed at COP26. Yep. And I know that last week there was some progress on it, but still needs to be landed at the end, hopefully, a much better space at the end of this week.
Christina, how should the proceeds from such a tax be used?
Well, I think one thing that we learned from the Yellow Vest movement in France is that, yes, you have to tax pollution, but that funding needs to actually be able to support those who would be negatively impacted by a raise in energy prices. And that was a very, very clear lesson that was learned, and one that is at least with intent already being planned by many countries because of that lesson.
Christina, we're going to be there. Fascinating conversation. We hope for more progress to come out of Glasgow. We'll watch with interest. Christina Figueres, former Executive Secretary of the UN Framework Convention on Climate Change. We really appreciate your time and your analysis. What are we going to talk about next? The end of the road for GE in its current form. Dean Drady from RBC Capital Markets is going to be joining us. Equity research analyst, covers GE. It's a 129-year-old industrial giant that seems to be, at least in its current form, coming to an end. It'll be interesting to see where the GE name ultimately ends up. Anyway, Dean Drady coming up to talk about this next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, Dr. Anthony Fauci. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. SpaceX has returned 4 astronauts from the International Space Station. NASA's Crew 2 mission splashed down off the coast of Pensacola, Florida late Monday, completing 199 days in space. The space agency was forced to alter its crew's launch and landing schedule due to disruptive weather over the past 2 weeks. In Nicaragua, President Daniel Ortega has won a 4th consecutive term after jailing his most popular opponents. Both the US and the European Parliament called the election a farce. President Biden is pledging to use diplomacy to hold Ortega accountable for abuses. And in the UK, Prime Minister Boris Johnson is under fire over a lobbying scandal involving a Conservative Party lawmaker. His government has been openly accused of corruption in Parliament, and even newspapers that are typically friendly took aim at Johnson's party. A new poll shows his approval rating at a record low. The giant General Electric, built by Jack Welch and his predecessors, will no longer exist. GE says it will split into 3 companies focused on healthcare, power and aviation. Healthcare will be spun off in 2023. Renewable energy, power equipment and digital businesses will be combined into a separate unit that will be spun off in 2024. The remaining company will be GE's airplane engine operation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Guy.
Ritika, thank you very much indeed. Let's dig deeper into that story. GE's trading 115 right now. It's up circa 6% on the back of this news. Our next guest has a price target of 127. Dean Dray, RBC Capital Markets equity research analyst, joining us now. As I say, outperform rating on the stock. Dean, we're trading 115. And we've got a nice pop on the stock. You got a price target of 127. What do you think the real breakup value of this business is?
Yes, Guy, thanks for having me on. We've been looking at GE valuation on a sum of the parts basis ever since Larry Culp joined, with an expectation that there could be a breakup coming. So our published sum of the parts model suggests that there's at least 20% upside on a breakup value. This all has to play out over time, so we're not surprised to see some of that realized today on the announcement, but we see at least 20% upside from here.
Wow. Which one would you want to own after the split?
You know, it's really interesting. That's the question I've been asked most frequently today. And I have said all along, if I were starting a multi-industry company today, I would want to be in the aviation business. The business model is so elegant that you get 7 to 8 times the revenues servicing a jet engine over its 30-plus year economic life at significantly higher margins. So if I had to pick one, that would be the one that I would like to see in the multi-industry portfolio. That said, healthcare business is a leader, and the power and renewables are also a leader, but you asked me to pick one.
Okay, let's ask about, if you had the opportunity to pick 2, my question is, why are they splitting aviation and power? You look at what GE's doing in terms of the race engines it's putting forward, the hydrogen power, it's working strongly with Airbus there. You look at the renewables business, you think about what is going to go on there and ultimately the direction of travel. There seems to be some overlap. Does it make sense to split those 2 businesses off?
You know, there was that thinking all along that somehow aviation would still be paired with the power business. If you think about it, a gas turbine is the similar technology as a jet engine. It's only stationary and it's attached to a generator. So there's all kind of synergies in terms of the technology, but not in the end markets. And in the end, this is an end market decision. And from that standpoint, that's the reason we're seeing them separated today.
Yeah, Dean, I have sort of the flip question of what Guy asked. It feels like when you're looking at low single-digit growth and high single-digit margins for the power renewable business, it feels like that's a utility. So versus something that has the growth kind of potential and the cyclical potential of the aviation business. And the reason why I feel like that is significant is A, for the rating, but B, what a lot of energy companies are dealing with in the energy transition. Like, are we moving to this all being utility-based versus like innovation cyclically based?
Well, Alex, you're exactly right. There is a utility aspect to the power business because the primary customer are utilities. You know, there are some of the aeroderivatives go into some industrial applications, but for the most part, it's a utility-based addressed market. And I like that you touched on the energy transition, because the power business that we knew over the past several years is transforming rapidly into green technologies, hydrogen, and the pace of change, I think, is going to be remarkable at the power business. And the turnaround has gotten traction in the past couple of years. I think you'll see a lot of change going forward.
What does this mean for other industrial conglomerates? Is this just an idiosyncratic story? GE didn't fit together, others do, or is there a lesson on conglomerates?
You know, there is an important lesson on conglomerates, and we've talked about this extensively. We've called this trend of the pendulum swinging towards the urge to demerge trend. So portfolio simplification, you call it addition by subtraction. But the market these days is rewarding these multi-industry companies for simplifying. And we've seen this happen. The last one of size was United Technologies breaking 3 ways. So in our note this morning, we said it's GE is the longest anticipated breakup. And so it is finally underway. We do think there are some others that could be urged along. We think the boards at companies like Emerson might take a second look. 3M has not participated in any of this simplification on a go-forward basis. So we think there are significant implications for the sector as a whole.
So would that be your next best guess, like a 3M? Like who would be first in that list?
So the one that probably bubbles up to the top in terms of anticipation, and again, we've published on this extensively, would be Emerson separating their automation business from commercial and residential solutions. Dave Farr, the ex-CEO and chairman, said that's up to the new CEO to decide. So it's come up on several of the conference calls. It's not they would be doing it from a position of strength if and when they decide to pull the trigger.
Hey, Dean, thanks a lot. Really great perspective. We enjoyed chatting with you. Dean Drey, RBC Capital Markets Equity Research Analyst. And stay with Bloomberg. Larry Culp, General Electric Chairman and CEO, will be joining David Weston on Balance of Power today at 12:30 New York time, 5:30 p.m. in London. Definitely do not miss that. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Peloton is expanding beyond cardio. The company, known for its stationary bikes and treadmills, has launched its first strength training device. It's a $495 set-top box with a camera that guides users through exercises. Southwest Gas has rejected an unsolicited takeover offer from billionaire Carl Icahn. The company says the all-cash offer for $75 a share undervalues it and is not in the best interest of shareholders. Icahn revealed last month he holds a 4.9% stake in Southwest Gas. And Netflix is making another attempt to attract younger viewers to its platform. The streaming service is rolling out a TikTok-type feature aimed at kids. It's called Kids Clips, and it will show short videos from Netflix's library of children's programs and movies. And electric truck maker Rivian Automotive prices its IPO today. It hopes to raise as much as $10 billion in a listing that could value the company at more than $70 billion. If the shares are sold at the top of the marketed range, it would be the 7th largest U.S. IPO on record. And that is your Business Flash. Guy, Alex.
Thank you very much indeed, Ritika. I think that's what, half the... No, I need to do my maths here. It's not far off half what Volkswagen's worth, which is amazing.
Yeah.
Absolutely amazing.
But then I also think it becomes, how much can they produce? It's the same kind of situation that Tesla was up against. One analyst in New Street Research was saying it's only about 300 to 400,000 units per year. There's going to be some kind of natural ceiling there for production. But I don't know, did you really buy Tesla for the actual production? No, you bought it for the potential and for the dream.
Okay, yeah. And to get from A to B, which, considering that they have the range that nobody else seems to have at the moment, was a huge draw in, just anecdotally talking to people about why they bought Teslas. So, yeah, I think part of the dream, part of the opportunity, and they led the market in a huge way. Yeah. Rivian, I think Rivian's story is really interesting, about the trucks that they've got there, but also the kind of the more of a focus on kind of commercial vehicles and what's going to happen there. They've obviously got this relationship with Amazon, which is going to be really interesting in terms of the way that allows them to access a market clearly Amazon needs to figure out different ways of delivering products and doing so on a more sustainable way. Certainly going to help the story.
Yeah, and you know, as of today, it does feel like a really good tape for these kind of IPOs. I mean, Hertz will be very indicative also, but the latest read there is that it could open at 28. The offering was priced at 29, so below the offering, but this is like a bankruptcy stock turned around quite quickly and now to IPO yet again. So, and if we are able to stabilize here, the NASDAQ 100 sort of off though because Tesla's getting hit, but that's more idiosyncratic. Michael Burry coming out and saying maybe you should kind of sell shares if you were, if Elon Musk should sell shares to pay some debt. But aside from that, it feels like it could be a relatively good tape because it's a pretty chunky IPO. Chunky, I'm using your words. This is so unfortunate.
Yeah, it's bananas. It's a story, though. Basically, you just the halo effect of EV is amazing in terms of the impact that it has on the share price. And there was a really interesting note out from Philip Houchoir a little bit earlier on this week from Jefferies on Volkswagen that seemed to imply maybe actually Volkswagen had taken that too far. At the same time, they upgraded their target on Tesla massively, 1,400, so they still see significant upside there. Some headlines coming through. Boris Johnson to travel Wednesday to COP26 in Glasgow. It'll be interesting to see actually whether that's an indication we're going to get some headlines on that. The European close is coming up next. This is Bloomberg.